Let's assume that you start a business in printing. You make an initial investment to buy a printing press, and then you start printing books, brochures, etc. for the customers. So this business has cash outflows, and then there are cash inflows by way of income. Also, you can sell the printing machine at the end of say 5 years, which will give you additional income, right? So in this situation, how much annual rate of return did you actually make? Sounds complex, but this can be easily answered using internal rate of return or IRR. IRR is a very important topic in finance, and in this video we'll learn all the basics of IRR, its formulas, calculations, its uses, and much more. Hi all, my name is Dheeraj Vaidya from WallStreetMojo.com, the home to most authentic information on finance and accounting. But before we discuss it any further, I want to highlight a very important thing. In order to understand this IRR concept meaningfully, you need to first understand this concept of net present value or NPV. So let's get started. So let us understand this concept of internal rate of return with the help of an example. Now, in this sheet we have is a project, and this project is a very simplified project. And in any project, what you do essentially is you start with an investment, and you do a capital investment, and then you expect returns over a period of time. So here also, we have this project, which is a cash outflow of $200 in year 0. Okay, and 1, 2, 3 represents the cash inflows from this project. After year 3, there's nothing as such, the project closes. Okay, so these are the expected returns, and this is your cash outflow in the initial year, and that's the project. You are expected to calculate the internal rate of return. I understand you still don't know how to calculate it, but you will, but in some time. Okay, so let's start by understanding first what is internal rate of return technically. Okay, so IRR can be defined as a discount rate at which NPV is equal to 0, right? What does this mean is that it's a kind of a break-even point where your present value of all your future cash inflows. What are the cash inflows here? 110, 120, 130. So these are the cash inflows. This will be equal to the present value of cash outflows. What is the cash outflow here? Cash outflow is $200. Present value is $200 because that is today, right? It's happening today. But the present value of these numbers will be different depending on the discount rate. Now, in order to find the NPV, we need a discount rate, right? And IRR is defined as a discount rate at which NPV is 0. So here in this case, what we will do as a first step to finding the IRR is to assume a discount rate. So let's assume that it is 10%, okay? And with that, what we will try and do first is to find out the net present value of this project, okay? So once we get the net present value of this project at 10%, we can use some iterative methods to kind of find a point at which net present value becomes 0. We'll come to that, but let's first calculate the net present value of this project, and then we'll do the iteration method later. So what is the present value of year 1 cash flows? Year 1 cash flow is 110. The present value will be 110 divided by 1 plus your discount rate. Okay, so this is your present value of year 1 cash flows. Present value of year 2 cash flows, that is 120 divided by 1 plus discount rate to the power of 2. Okay, and what about the present value of year 3? 130 divided by 1 plus 10% to the power of 3. Okay, so what is the sum of present value? that comes out to be 296.84. So if you look at this equation, we know that present value of cash inflows has come out to be 296.84. What's the cash outflows? The cash outflow is $200. Okay. So what is the net present value? The net present value is basically the sum total of these two, cash outflows and cash inflows. When we do the sum total, we get the net present value. So in this case, what has happened is we got a net present value which is positive, right? So now we also know that discount rate and net present value are inversely proportional. Okay, so as you slowly increase the discount rates, your net present value should decrease. Okay, and we have to come to a point where your net present value is 0. Okay, and that will be your internal rate of return. So as a next step, I'll start with the iteration and slowly, move this discount rates from 10% to 15 and so on and so forth. Let's see what happens at 15%. Okay, so at 15% discount rate, the net present value reduces to 71.87. How about increasing the discount rate to 20%? So this becomes 50.23. What about 30%? This becomes 14.79. So let's try 35. Okay, so here we have, this is closer to 0.16. How about 36? Okay, so this is negative, minus 2.56. So basically the discount rate is, or the internal rate of return is between 35% and 36%. Let me try 35.1%. Okay, so this is again closer to 0. How about 35.05? And it is 0.02, maybe 35.055, 0.01. So I'm still getting closer to it, right? So at 35.059%, the net present value has become approximately equal to 0. And this is your internal rate of return. Okay, so here we have this number as the internal rate of return, and it is nothing but the return that we get from the project. Okay, so this is the first methodology of calculating the internal rate of return which we learned, and it is the process of iteration or trial and error. The second method is very, very simple. So this second method uses the Excel function IRR, and whatever the long form calculations we did here, they're absolutely not required at all, because the answer comes in a second with the usage of this formula. So let's do that. This is the IRR function which we are going to learn now. So the function goes like this, equal to IRR, and it looks for two values, two things, values and the guess. I'll come to both of them. The values is nothing but the cash outflows and inflows, the overall cash flows which we have. Okay, from D7, that's the cash outflow, and here these are the cash inflows. Okay, and the second part is the guess. Now, what do we mean by guesses? You remember we started the discount rate with 10% and then slowly moved towards the internal rate of return finally. Likewise, Excel also requires a guess to start with. So it can be 5%, 2%, any number that should be positive number. So let me start with 5% as a guess. Okay, and you just press enter. So all the iterations which we did here will be done by Excel. And let's see the answer. So as you can see here, the answer comes out to be 35.0591%. So obviously this is a much easier function to look at for calculating IRR, and all the analysts like us do prefer this one to work upon. So now that we understand how to calculate IRR using these two methods, the trial and error method and the IRR Excel function method, and we also know that using this IRR Excel function method is way easier, and your life can't get easier than that. But for some reason or other, if you want to refer to the formula of IRR, here it is for you. So please do not get bogged down by looking at this mathematical function. It is exactly what we discussed, though it is represented in a way more mathematical format. So look at this left hand side first. Here we have this NPV, this is equal to 0, right? So we discussed that internal rate of return is a rate of return at which NPV is 0. So that's what this left-hand side is all about. Now look at this part, which is CF0 and the cash flow 1, cash flow 2, etc. Now this is the same thing which we discussed earlier. Cash flow 0 is your present value of your cash outflows. So here we had this $200. This is CF0 cash outflows, right? And this CF1 divided by 1 plus IRR to the power of 1 and so on and so forth. This is your present value of cash inflows. Okay. So what we said about IRR was that a situation where present value of your cash inflows will be equal to your present value of cash outflows. This will result in a NPV of 0. And at that point where you will find the discount rate, this will give you your IRR. Okay. I understand if you use this pen and paper to find this IRR, you won't be able to do it because it is a fairly complex mathematical equation and can't be done with hand. And that's why either you do this trial and error method using Excel or you use this IRR function in Excel. Okay. Let us now get a visual understanding of internal rate of return. And for that, we will use this sheet called as the NPV profile versus discount rates. So in this sheet, basically two things are happening. One, on the left-hand side, we have the discount rates. And for each discount rate, we will calculate the net present value. And the second thing is that as we calculate the net present value, we should be able to get the graphical form of this movement of NPV vis-a-vis discount rate. Do understand that NPV is inversely proportional to discount rate, right? We discussed this earlier. So we just want to see visually how it goes and at what point does NPV become 0. And that will be the point of our internal rate of return. Okay, so let's calculate the NPV for each of the rates and then see how it moves graphically. Okay, so for calculating NPV, I will use the NPV function, which we have used earlier. The first thing that needs to be given is the rate and the next is the values. These are the future values. So this is 110, 120, 130 and then we also add the cash outflow. So this portion will give the present value of all the future cash flows and this is the cash outflow, right? So this will become our NPV. Okay. So now that we have this calculation of NPV for 0%, we can do the same for the other discount rates as well. So I can actually copy paste the same formula, but with a minor tweak, I might want to use this as along with the dollar signs, these ranges, so that they don't move when I copy and paste the formula from top to bottom. These dollar signs ensure that they are static, they don't move at all. However, if I haven't put any dollar signs in front of C11, C11 is nothing but the discount rate. The discount rates will keep on moving from top to bottom as I copy and paste the formula. Okay, so for more information, please refer to the absolute and the relative references, and I'm sure you will get the meaning of this formula altogether. Okay, so now let me just copy and paste the NPVs. So as you can see here now, the NPV for 10% is recalculated here, right? And as we do that, the graph gets slowly plotted on the right hand side as well. So let me do that quickly. So as we move from top to bottom, you can see that the NPV was positive initially, but it is now negative at 100%. Okay, so as we increase the discount rates, the net present value will decrease. Okay, and how did we define the internal rate of return? Internal rate of return was a place at which your NPV becomes 0, correct? A rate at which NPV becomes 0. All right, so for this exact project, we know what the IRR is. So let me try and put that IRR as well. So here I have put 35%, that's a rounded number. Let me now put the exact number. 35.0591%. Okay, so I'll do that. And as you can see here, NPV is 0. So with this NPV profile, what happens is you get a clear understanding of the movement of your NPV, okay, along with the discount rates. And the point of intersection at which your NPV becomes zero is your IRR, okay? And that's how you can visually understand what IRR is all about. IRR is super useful in capital budgeting when you're comparing two projects, or if you want to see which project to accept or reject. IRR is a thing that you must do. Okay, so let's look at this example here. We have the first one as the same example which we have been running throughout this video, and I've just hypothetically created another example as well for simplicity's sake. So the objective here will be to, let's say, come up to a situation where we can say that, okay, accept this one and reject this one, or maybe reject the second one and accept the first one. What should we do? Okay, this basis of acceptance and rejection depends on your expected rate of return. Okay, so I'll call this as KD, or it is also called as cost of capital or discount rates. Okay, management expectation of rate of return. So let me just call this as KD, or the expected rate of return. Okay, now if IRR, or the internal rate of return, is greater than your expected rate of return, okay, if this is a situation, this means you're earning a rate of return which is much higher than your expected rate of return, right? So in that case, you accept the project, okay? So you accept the project. In another case, it could be that your internal rate of return is less than your expected rate of return. In that case, you reject, okay? You basically reject the project altogether. Okay, so let's find out what happens in this case. But before we do that, we need to know what is our expected rate of return. So let's again randomly assume if it is 10%. Okay, my expected rate of return in this example I've put in as 10%. So let's find out the IRR for both the cases and come up to a conclusion of whether we should accept or reject. Okay, so here I'll use the formula IRR. Values are all the values, cash outflows and inflows, and then a guess, 5%. So we get this as 35%, 35.06 here, okay? But what about the second one? IRR, values, and a guess, let's say 5%. So what do we get here? This is 7.27%. So in this first case, 35.06 is greater than 10%. So in this case, we'll accept the project, okay? As simple as this. On the other hand, when we look at the second one, 7.27% is less than 10%. So you basically reject the project, okay? So this is how you basically can compare two projects and accept and reject as such. Let us now look at some of the most important uses of IRR. So IRR is most frequently used in capital budgeting. It helps businesses that want to look at different projects for investment opportunities. So as long as your IRR is greater than your cost of capital, you can always accept the project. Another use is that private equity firms use IRR to figure out how much money they make from investing in different businesses and startups. Also, as an individual, you can use IRR to figure out how well your different investment options like fixed deposits, mutual funds, insurance, and so on are actually doing. One another thing that you can do with IRR is to figure out how well your company's share buyback programs work. IRR has various limitations as well. Let us discuss some of them. The most important limitation of IRR is that it runs into a mathematical problem when a project kind of earns a positive cash flows in a few years and then returns a negative cash flow in another year. So in that situation, you can get multiple IRRs, and this can lead to a lot of confusion regarding which project to select. Another limitation is that IRR itself is derived from cash inflows, cash outflows, which are kind of an estimates, right? This means that the type of assumptions that you use for the project, for the revenues, the expenses, etc., will affect the analysis. And we all know that no two analysts will come to the same assumption, right? Another problem is that difficulty in comparing projects that are of different sizes. Just imagine, one project needs a mere $100 in terms of investment and another needs $1 million. Then which one will you choose if they have the same IRR? Similar issue arises when we are comparing different time horizons. Say for example 1 year versus 10 years.
As we conclude today's discussion, a big thank you to everyone who tuned in from the Wall Street Mojo team. But hold on, the financial adventure continues. The next episode unfolds on Tuesday, and we're super excited about what's in store. Make sure to subscribe and turn on those notifications so you don't miss out on the financial insights coming your way. Until next time, this is the Wall Street Mojo team signing off. Stay informed, stay engaged, and stay Wall Street Mojo awesome.